Leverage remains insanely high at $647 billion, 55% higher than at the 2007 peak and 116% higher than at the 2000 tech peak. Total margin debt has exceeded 3% of gross domestic product only 3 times. The first time in 1929, and then last year and this year. Leverage may seem like magic on the way up, but the effects are horrifying when prices fall. The unwinding of margin debt between 1929 and 1932 resulted in an economic depression as the phenomenal wealth driving the nation's economy evaporated. Stock prices fell as much as 90% after soaring 4.2-fold in only 9 years and 4 months. The damage was so extensive that the Dow Industrials did not fully recover until 26 years later in 1955. Thus, we look at today's stock market and worry about the similarities. In only 9 years and 4 months from the previous bear market bottom in March of 2009, the Dow Jones Industrial Average has now surged 4.1-fold, almost exactly the same as the run into the 1929 peak. While we may not have an exact repeat of the 1929 through the 1932 period, when excessive leverage led to a crash and a collapse into an economic depression, the current environment is way too similar to past manias, and in certain aspects, primarily leverage, is far worse than the 2 prior peaks in March 2000 and October 2007. So let's take a look at the margin. So this chart shows the FINRA margin debt and the S&P 500. The information comes from Advisor Perspectives. And as indicated up here in the upper left, the margin data is through June 2018. But I think what they do is with regard to the margin data, they extrapolate that out a little bit. So this is perhaps the last portion here is the extrapolation. They only extrapolate only about a month or so. And the S&P is at this point here. It does not show the reflection and upward move, again, because this is a couple of months old by this time. So looking at this here, you can see that we peaked, at least in the margin debt, probably in late 2017, early 2018, and then we had another peak, and it is beginning to fall, and that probably is the extrapolation. But as we can see in previous periods here, such as this peak in early 2015, going back to the peak there in, say, mid-2007, and then, of course, the peak here at this point in about early 2000, each of those peaks in the margin debt coincided with a downturn, or a downturn in the S&P 500 followed relatively shortly after the peak in the margin debt. So we need to keep our eye on this chart here, because once the margin debt starts to consolidate, then the S&P 500 is going to follow soon enough. Let's go take a look at a couple of more charts. This chart here shows a little bit different perspective of the margin debt. And what it shows is sort of a better idea of the timeline. And looking either at the red real margin debt growth or the blue, which is the S&P 500 growth, you simply look at one dot to the next. And that movement in one dot to the next is a period of 1 month. So this is measured 12 times every year. And what's important is to take a look at, say, some periods such as here in, say, mid-2012, we had a pretty good rise in the margin debt. Things were moving on up. But it's when you start to get the clustering and a non-upward movement, that can also cause a consolidation in the actual stock market, the indices, such as here, a little bit of a consolidation in this period here. So on up to the current time frame, or as current as we can be, it's again starting to cluster. So that's just a little yellow warning sign. When that starts to cluster, that means that there's no more upward movement in the margin growth or the margin debt growth, and therefore you might get a stall in the S&P or any other indice. So keep your eye on that clustering, the non-movement. Let's go take a look at one more chart. And this chart here, also from Advisor Perspectives, shows the investor credit and the market overlaying with the S&P 500. You have a positive balance that's shown in the green, a negative balance that's shown in the red, and then the S&P 500 is the blue line. This is different than the previous charts we took a look at. This shows the credit balance, which is calculated as the sum of free credit cash accounts and credit balances in margin accounts minus margin debt. So it's different than the first two charts that we looked at. And it isn't necessarily important that you know the difference between all these charts. What is important to note is just the relative levels that we're at. And as you can see, the current level of investor credit is quite a bit negative, and it simply dwarfs the periods when we were at the June 2007 timeframe, right before the great financial crisis, and then back in February 2000, right at the peak of the dot-com bubble. So again, you don't have to pay attention to the nuances of these. Just simply important to take a look at the magnitude, the relative differences. And right now, there is a monster mountain of investor credit and margin. I learned my margin lesson back in 1987, and although I've used margin since then, I use it very, very carefully, and I would recommend that to you as well. And so for today, that's ChewDog Charts. Thank you.